It's just turned 10 o'clock. Good to see everybody. Happy May again. Happy May 14th. Let's get going. First, huge announcement for you folks. There will be a new webinar day starting in June. As of June 5th, this will be no longer a Tuesday weekly webinar. It will be a Wednesday 10 a.m. weekly webinar. There's a lot of scheduling reasons for that, and I've thought about it for a bit of time now, but it's time to make that change. I apologize if that conflicts with some of you who watch this live. I hope you can make adjustments to your calendar. But if not, we deliver these webinars right to your email inbox, and you can listen to them, listen to the recording at any time. And really, it's available. I'll tell you exactly what we do. We keep this live recording, right? Because it's recording as we're doing this, obviously. So it stays as a live video on YouTube until late Friday night, early Saturday morning. You can access that during that this recording that way, all during that time. So if you miss it, go into that same link. Go into that same link that you get to access this, and you can go into there, and then you can listen to this video, and you don't have to hear me mispronounce things and things like that. You can just move forward, and you can jump right to different sections. But then we repackage it and do some editing, and then release it as a recording and turn off the live recording so as not to confuse YouTube that we have two things of the same name. That's really why we do that. So then you get the cleaner, better version of, hopefully better version of today's webinar delivered to your email box if you're on our email list. And if you're not, reach out to us at questions@attaboywealth.com. That's questions@attaboywealth.com, and be asked to be put on the website, or onto the email list, or you can go right to the website, attaboywealth.com. Go into the webinars where there's, I think it's called Education and Resources, drop down webinars, and then you can sign up to be on the email list, and you'll receive all the notifications of everything that we do, including the recordings. But if you just go onto our YouTube channel, and if you haven't subscribed already, you should subscribe. Hit the subscribe, like, and notification buttons, and therefore you'll never miss anything. As soon as a new video is posted, then you're going to get that new video. So that is everything. So as of June 5th, we're going to be Wednesday weekly webinars. So you got a couple weeks to prepare for that. So I want to remind you of my goals for you for this webinar. I want you to be inspired to make changes and really change the way that you've been thinking. Open your mind to different ideas and ways of thinking about planning and investing. You've heard many of the same things for 30, 35, 40 years, however long you've been doing this. Maybe you're a younger investor. We've got some younger folks listening now because I did the series about investment fundamentals or essentials for young adults. So even hopefully you're hearing these things early in your time of planning and investing, because so many times people have sat across the table from me or the webcam from me and said, geez, I wish I would have learned about this 5, 10 years earlier. But I want you to open your mind to different ideas and different ways of thinking, because you have to think differently. We're going to talk today about some proposed changes in the tax law that could affect many, many people. And these changes are coming. I don't know if they're coming this year, next year, 5 years, or 10 years from now, but they have to come. Maybe not the ones we're talking about today, but certainly increased tax rates have to come. I want you to stay educated so you feel confident in the plan and strategies that you're put into place, because you have to constantly remind yourself about these things when we're talking about tax efficient planning, using things like funding your Roth IRAs, Roth 401ks, doing conversions, things like that other people are still fighting against. We still have CPAs out there that are saying don't pay your taxes until you have to. I would say you really have to when rates are as low as they are today. So I want you to stay educated so you can be on top of that, and you can stay consistently motivated. I want you to stay updated so you can make adjustments along the way, because things change. Things change for you. Things change outwardly in the economy, tax code, all these things change. So you have to stay updated. It's simple. You don't have to become an expert. You just have to listen, and you have to stay updated. And it's easy now. It's so much easier now. All you have to do is plug in once a week, put your headphones in, your AirPods, whatever it is you're listening on. Do it on your treadmill while you're walking your dog, whatever your thing is, and you can stay updated. I promise you I'll do the best I can to keep you all updated. All right, so we're going to go through our normal format. We have our slot updates, that'll be about 15 minutes. We're going to talk about market updates and analyst reports, and then we're going to have our financial planning topic, which we call our Financial 15. And today's topic is we're going to talk more about the proposed tax code changes that are coming out of Washington, out of the White House. And it's referred to as the document I'm going to refer to as a general explanation of the administration's fiscal year 2025 revenue proposals. And when you hear revenue proposals, just hear proposed changes to the tax code. And I'm specifically still focusing on modifying rules, the section that reads modify rules related to retirement plans. And it's really one sentence we're going to be focused on today, but it's a big sentence. So that's our Financial 15. We've got some headlines. So last week I told you we've got some things this week. The Producer Price Index and Consumer Price Index are big ones, two of the big ones. Well, Producer Price Index, those wholesale prices came out this morning, and that index rose 0.5% in April, more than expected. I think the expected amount was 0.30%, so significantly more. So 0.50 compared to 3.0 is a lot. The futures, I was listening to this as I was getting ready this morning, and I was watching the screen on CNBC, and I saw the futures, what they're basically projecting the market to do, go red, which means negative, right? So we expected the market to open negative. That's not the case, though. I'm sitting here looking at it, and it's up slightly. So that's a surprise, and I'm just constantly pleasantly surprised at the resiliency of this market. But that doesn't mean that we should just take things for granted. We talked about last week, and I'm going to just mention it again. Remember last week we got the Social Security and Medicare trustees report, and the situation is not really any better than it was before. Social Security is still set to run out of money. The trust for Social Security is set to run out of money in 2033, same as the year before. Medicare, we did get an increase in years, so we're not set to run out of money now until 2036. Still not a good situation. Nobody's going to take those cuts in benefits, so something has to be done very, very soon. We're going to get through this discussion over the next couple of weeks about the proposed tax code changes that came out of the White House, and then we're going to focus a bit on the trustees' reports. We're going to break that down. All right, let's get into the Slott Report. So here we are. And I have a gift for you folks. And when I pulled up this second part of the Slott Report, I sent it. I created a document for myself, and I sent it out to the team. And I said, you should save this as a PDF and save it in your desktop. So I'm suggesting you do the same if you want to have some easy access to inherited IRA beneficiary information that is really easy to follow. But first, we're going to talk about the Slott Report mailbag, and the first section is qualified charitable distributions and solo 401ks. So this is from our friend Ian. Ian is very direct, and you can hear it in the response to these questions. So let's ask the first question, or answer the first question here. So can a QCD, a qualified charitable distribution, be made from a 401k plan? QCDs have become very, very popular. It's a way to draw funds out of your IRAs and send them directly to qualified charities. And there's two basic rules. Well, three basic rules. You have to attain the age of 70 and a half. I know 70 and a half is an old, outdated age. Now, it sounds like the old RMD age, and it was the old RMD age, but now the new RMD age is 73. And in about 8 years now, it's going to be 75. But they still saved that age of 70 and a half for qualified charitable distribution. So that's rule number one. You got to be at 70 and a half. Rule number two has to be a qualified charity that receives those funds directly. And rule number three, there's a limited amount that you can put in. It's $110,000 a piece this year, and that does adjust for inflation now. That's a new change as of last year. So let me read the question again from Ian. Can a QCD, qualified charitable distribution, be made from a 401k plan? Ian writes, no, QCDs can only be made from IRAs and inactive SEP or simple IRAs. One possible workaround would be for you to roll over a portion of your 401k funds into an IRA and then do a QCD from the IRA. So good question and good direct answer. So you cannot do a QCD directly from a 401k plan. Next question. We have a client who is self-employed. He has a 401k plan for himself and his wife. Is the 401k protected under ERISA from creditors? Employee Retirement Income Security Act. So that was from 1974. And ERISA is the strongest, I'll say it's commonly referred to as the strongest fiduciary requirement that we have on the books. So these ERISA plans have a lot of teeth behind them. And you're talking about typical 401k plans, retirement plans. And ERISA is often referenced to for fiduciary best practices. So it's important to know ERISA. But the answer here that you know that to this question is a solo 401k plan where just the business owner and spouse participate is not an ERISA plan. So it does not have ERISA protection against non-bankruptcy creditors. The plan would have only whatever creditor protection is available under state law. The Federal Bankruptcy Code does protect solo plan accounts in bankruptcy. Hiring additional employees would turn the solo plan into an ERISA plan with ERISA creditor protection, but having an ERISA plan would also introduce new administrative requirements. So basically, the question there, the answer is you've got to check with what the creditor protection is in your state. And bankruptcy protection and creditor protection is different. I did a webinar about this. It's been a little while now, but I think I went down and I broke down in the states what states had what protections. But again, you might hear that, well, even more if we're talking about an ERISA plan. So you got a typical retirement plan, 401k, 403b, that is rolled over into an IRA. You'll hear that the characteristics, the bankruptcy protection of that 401k rolls over to the IRA because the IRA bankruptcy and creditor protection is specific to states. But you don't necessarily, again, bankruptcy, you might have complete bankruptcy protection on your $2 million that you roll into your 401k, but your state could limit that to $1 million or your creditor protection to $1 million. So bankruptcy protection and creditor protection are different. I know that's confusing. I hope it's a little less confusing now. All right, here's the real gift that we have this week from Ian, a cheat sheet for IRA beneficiary RMD. So this is extremely confusing. So we all know that when you attain the age of 73 now, you have a triggering event that's that age of 73, and you must start taking your required minimum distributions. And for the very first one, you have until April 1st of the following year, after you turn age 73, to take that required minimum distribution. But again, only for that first year. And most people take their required minimum distribution by the end of the year. In the year they turn 73, so they don't have to take two the following year. So it's relatively simple. You go to the Uniform Lifetime Table, and most custodians will calculate that for you. But if you don't have that situation, you figure out the total of all of your IRAs, and you can aggregate IRAs. You can't aggregate IRAs with your retirement plans, but that's a whole other discussion. But you can pull all of your IRA money together for that calculation, and you can take it out of one or all of your IRAs for your required minimum distribution. And again, it's based off of the Uniform Lifetime Table. You can download that from our website, attleborowealth.com. Go to the slot corner, go down to the bottom, and you'll see tax planning documents. And you can download the Uniform Lifetime Table, and you can see at what age the amount that you have to take out is. That's for your own IRA. Inherited IRAs have always been slightly confusing, but now they're terribly confusing because it depends on when you inherited it, who you inherited from, how old that person was when they passed away, whether you're an eligible designated beneficiary, non-eligible designated beneficiary at all. So there's a lot of confusing things, and I just love this cheat sheet. So again, I passed it around to my team, and I said, hey, make sure that you save this and use it for reference because it's perfect. So I encourage you to do the same. And if you want this, you can reach out to us at questions. Here we go. questions@attaboywealth.com. That's questions@attaboywealth.com, and I'll email it over to you. So Ian writes, it's been over 4 years since the Secure Act upended the rules for beneficiary IRA required minimum distributions. And there's still plenty of confusion about the new rules. The IRS did give us proposed Secure Act regulations in February 22, but those rules still haven't been finalized. They have raised a lot of new questions. Here's a cheat sheet on how the rules currently stand for IRAs inherited after 2019. Pre-Secure Act rules apply for IRAs inherited before 2020. So we do get that question a lot. You know, my mother passed away in 2019. I've been taking distributions from her IRA per the RMD rules. Now, do I have to follow the new RMD rules? And that's not the case. It's before the act and after the act. So 2 important questions. First, we always need to answer 2 important questions. Did the IRA owner die before or after his or her required beginning date? RBD for RMDs. The RBD, as I told you just a moment ago, the RBD is April 1st of the year following the year the IRA owner reaches his first or her first RMD year. The first RMD year is age 73 under Secure 2.0 currently. A Roth IRA owner is always considered to have died before her RBD. So another great reason to consider Roth conversions. There are no RMD requirements for you or for your heirs. Second question, is the IRA beneficiary an eligible designated beneficiary, an EDB, a non-eligible designated beneficiary, an NEDB, or a non-designated beneficiary, an NDB? An EDB is a surviving spouse of the IRA owner, a minor child under 21 of the IRA owner, a chronically ill or disabled person, or someone not more than 10 years younger than the IRA owner. An NEDB, non-eligible designated beneficiary, is an individual beneficiary who isn't an EDB. An NDB is a beneficiary who isn't a person at all. For example, an estate, a charity, or certain trusts. So I hope you got all of that. And folks, I've told you before, if you look at the bottom of my notes here, I keep on my notes, and this is cut out actually on my desk, the 5 classes of eligible designated beneficiaries. They include surviving spouses, minor children, the account owner, disabled individuals, the chronically ill, and beneficiaries not more than 10 years younger than the IRA owner. So if this sounds confusing to you, don't let it bother you, because again, I don't ever want to risk misclassifying somebody. So traditional IRA owner died before required beginning date, or Roth IRA owner died at any time. Because again, no required beginning date for Roth IRA owners because there is no required minimum distribution. Hope that makes sense. An EDB, eligible designated beneficiary, a non-surviving spouse EDB can elect to stretch RMDs over his or her life expectancy or have the 10-year payment rule apply. If the 10-year rule is elected, the entire account must be emptied by December 31st of the 10th year following the year of death. However, no annual RMDs are required during the 10-year period. Note there are different rules for surviving spouse EDBs who inherit after 2023. Great point there. How about non-eligible designated beneficiaries? So everybody else other than those 5 I talked about. The 10-year rule applies, but no annual RMDs are required. Remember, this is for people who died before, let's see if I can highlight this, required beginning date, or is a Roth IRA owner. There are 2 really distinct options here, or requirements here. There are 2 really distinct requirements here. So, person dies before the required beginning date, and then you're a non-eligible designated beneficiary. The 10-year rule applies, but no annual RMDs are required. How about a non-designated beneficiary, a non-person, estate, a trust, etc.? The 5-year rule applies, so the entire account must be emptied by 12/31 of the 5th year following the year of death, but no annual RMDs are required during the 5-year period. Now, let's look at traditional IRA owner died on or before required beginning date. Let's highlight that for you. On or after, I said before. I didn't mean to say before. Traditional IRA owner died on or after. I'm going to Underline that. On or after required beginning date. An eligible designated beneficiary. Stretch RMDs apply, but if the eligible designated beneficiary is older than the deceased IRA owner, the EDB, eligible designated beneficiary, can use the deceased person's older life expectancy in calculating the RMDs. However, the inherited IRA must be emptied when the EDB's life expectancy runs out, and RMDs are required under the current law. I wish he would have said that a little differently, but when he writes stretch RMDs apply, that means you must take required minimum distributions. You also have to empty it either when the life expectancy runs out or the end of the 10th year. But required minimum distributions apply if the traditional IRA owner died on or after the required beginning date, not after they turned 73. They may have turned 73 in October. The required beginning date is April 1st, as we just learned, or as I reminded you. So even if they passed away between October and April 1st, there are no required minimum distributions. But if it's on or after April 1st, then required minimum distributions must continue. Remember, our friend Sarah Brenner used the great comparison of the Rolling Stones song, "Start Me Up." Once you start, you never stop. Same thing. Once those RMDs start, they never stop. How about a non-eligible designated beneficiary? The IRS proposed regs say that both the 10-year rule applies and annual RMDs during the 10-year period are required. However, because of widespread confusion, the IRS has waived the annual RMD requirement for 2021, 2022, 2023, and 2024 in this situation. And I just realized that I misspoke on the first one. So I said that for eligible designated beneficiaries, and this is an example of how confusing this is, that it has to be emptied by the end of the 10th year, and I added that to the inherited IRA must be emptied when the EDB's life expectancy runs out. So scratch that. Just follow the instructions there, because I was laying over the requirement for the non-eligible designated beneficiaries that the IRS proposed regs say that both the 10-year rule applies and the annual RMDs during the 10-year period are required. And as I just said, and this is an example of the confusion of the rules and what the IRS has handed us, because you may have remembered me saying that they gave us one set of directions and then they gave us another set of directions that conflicted. They actually came out and they said, after the one set of directions, they said, we made a mistake. We shouldn't have said that. We're saying it the other way. So because of that, the IRS has waived the annual RMD requirements for a non-eligible designated beneficiary for 2021, 2022, 2023, and 2024 in this situation. Hopefully we get some permanent or final regulations by the end of the year this year. So a non-designated beneficiary, the annual RMDs must continue over the deceased IRA owner's remaining single life expectancy had he lived. That's called the ghost rule. Remember, that's for folks who died on or after the required beginning date. Whew. Okay, so if you want that information, reach out to us and we'll get you a PDF version of that to share. All right, let's talk about the markets. So we had a good week last week. And I'm going to first read our analyst reports that tell you why we had a good week last week. So initial jobless claims. This is what we had come in last week. This forward-looking labor indicator increased more than expected. So why would the market like the idea that jobless claims are higher? Well, it helps give some support to the idea that the Fed may not be, we're not really concerned about them raising rates again while they can. But we're looking, the market as a whole, I don't think it's likely to happen, honestly, in 2024. But if at all, it's going to be towards the end of the year when I'm talking about rate cuts. I think we're going to be here probably for the rest of the year where we are today. But that's just my opinion. We could see rate cuts, heck, starting in June again. Probably not. Don't count on that. But maybe September, maybe towards the end of the year. But I think we're going to probably stay pat for the rest of the year. But initial jobless claims being lower are good for the idea. that we can start to cut rates to help spur the economy again. Because if the Fed cuts rates, their concern is the economy is going to pick up again or continue to be overheated, and then inflation is going to rise again. So we saw an increase of 231,000 compared to the expectation of 212,000. So the analyst writes, 1 week doesn't make a trend, and we urge investors to pay more attention to the 4-week average reading, but this week's reading is the second indicator in a week after a soft labor market report that the long-awaited easing of the job market may be occurring. However, the Federal Reserve is going to need to see much more evidence that labor is softening and inflation is reversing its recent trend and moving lower. And today we got the producer price index, and it was, as I shared with you at the beginning, it was 0.5 compared to 0.3. So that's not likely to give us any kind of fuel for reducing interest rates. Tomorrow, we get consumer price index. The CPI will be the highlight of the report this week as investors look for the downtrend in inflation to reestablish itself. Also tomorrow, we see retail sales, and Friday, we see leading indicators. Leading indicators have been hovering near the recession line after having turned higher recently. Investors will be watching to see if the economy is slowing in response to higher interest rates. So what did all that mean last week? The Dow Jones Industrial Average was up 2.2% last week. The S&P 500 was up 1.89%. The NASDAQ was up 1.17%. The MSCI World Index, that's all the large company stocks, excluding the U.S., was up 1.80%. Emerging markets was up just about 1%. Europe, Asia, and the Far East was 1.80%. And even the bond market was up slightly, 0.09% last week. That's the U.S. aggregate bond market. The 1 to 3 year bond market was up 0.01%, but that is still positive for the year. The 1 to 3 year bond market is up 0.58%, while the U.S. aggregate bond market, which is 7 to 9 years, that's where your average investor probably has most of their money in bond funds, that's still down just about 2% at 1.97%. So a good week last week. We'll see. Here we are Tuesday. We'll see where the market ends this week. So this now is going to start our Financial 15 section. So we're coming off of the weekly webinar, and we just spent several minutes talking about updates, IRA distribution updates from the Ed Slott Group. Some really good stuff this week. One very good cheat sheet about requirements for inherited IRAs. We talked about the markets, some market updates, some analyst reports, and we talked about the change of our schedule to Wednesdays from Tuesday weekly webinars. And now in the Financial 15, this is typically a financial planning topic, and this is definitely a financial planning topic or strategy that we hope will help you move forward in your financial plan and how you're thinking, and maybe open your mind to different things. But we're going to talk about the proposed end of backdoor Roth contributions. So let's talk about this a bit. We're first going to talk about what is a backdoor Roth contribution. I don't know why. I had a conversation with our friend Sarah Brenner from the Ed Slott Group about this, but for some reason, this has recently been referred to as a backdoor Roth conversion. If you see backdoor Roth contribution or you see backdoor Roth conversion, they're the same thing. The phrase backdoor Roth conversion kind of sticks in my head a little bit because, or sticks in my craw a little bit because it's not a backdoor Roth conversion. You can do a Roth conversion. We haven't. You can convert as much or as little as you'd like. Income doesn't matter. There's no reason to backdoor a Roth conversion. There's no such thing. But there is a backdoor Roth contribution because there are some requirements and limitations on who can make contributions to a Roth IRA. So the mechanism we're talking about is a backdoor Roth contribution. It allows you to make contributions to a Roth IRA if you've earned what the government considers, or what the tax code considers, too much money. So let's just talk about that for a second to give you a foundation. But I just want to say again, if you read backdoor Roth conversion, backdoor Roth contribution, it is the same thing. It's just being used the wrong way if they're saying backdoor Roth conversion. So we're going to focus here, and this is what I'm referring to here is a 2024 plan contribution limits. And again, you can download this from our website. If you go to attleborowealth.com, it's over here, attleborowealth.com. You go to the slot corner, scroll all the way down to the bottom, put in your email, and you can download these tax planning forms. One of them is the 2024 retirement plan contribution limits. So I'm going to go down here to the bottom left of this form, and we're going to look at 2024. So for a married filing joint person, taxpayer, this is based on modified adjusted gross income. But remember, not including Roth conversions. This is important. Remember, I did a video about, hey, that CPA got it wrong, and it happens just about every year when somebody comes in and says, hey, you did contributions for our client, and you shouldn't have because their modified adjusted gross income was too big. But this modified adjusted gross income does not include Roth conversion. I just realized that you can't see what I'm writing. There is an exception for Roth conversions in this modified adjusted gross income calculation. But if you have modified adjusted gross income that doesn't include Roth conversions, and you're a married filing joint person, and your modified adjusted gross income is greater than $230,000, all the way up to $240,000, you're in this phase-out range. So phase-out simply means that you can make less and less of a contribution into your Roth IRA. And once you reach over $240,000, you're out. You can't do any contributions. I'm saying contributions, not conversions. This only applies to contributions. But if you're over those phase-out levels, you can't make any contribution, or you make less and less of a contribution into your Roth IRA, and it's a formula. And then once you reach over $240,000, then you can't contribute at all. And if you're single or head of household, obviously your thresholds are lower. It starts at $146,000 for this year, and it tops out at $161,000. And you can see the previous year. So the good news is that this does adjust for inflation. So from 2022, the top phase-out level has gone from $214,000 to $240,000. So you'll see these adjustments for time, over time. But for many years, people have been taking advantage of an allowance in the tax code referred to as a backdoor Roth contribution. So what does that mean? Simply put, remember, here are your buckets. We've got your taxable bucket. We've got your tax deferred bucket. And you've got your tax advantaged or tax-free bucket. And we're going to focus on the Roth here. And in your tax deferred, we're going to focus on IRA here. And your taxable is, remember, this can be your money markets, your CDs, your mutual funds, your stocks, anything that is not a retirement account, or whether it's Roth or individual, traditional. So anything that is not retirement account is what we refer to as taxable, but we're going to focus on IRA. So we said that if you make too much money by these guidelines, as told by these guidelines, then you can't make contributions. And also as a single filer here, you can't make a contribution to a Roth IRA, but you can make conversions, or no income limitations on conversions. So what the current tax code allows for is, hey, you can make a non-deductible IRA, traditional IRA contribution into your IRA. And then, since you don't get a tax deduction, you've already paid tax on that money. It could either come out of this taxable bucket or out of your earnings. It doesn't matter where the money comes from. It's going into a non-deductible IRA, right? Non-deductible IRA. So you can't deduct it. And then you immediately move that money over to your Roth via Roth conversion. And now it's just like you've made a contribution into your Roth IRA. Very, very simple. There are, of course, some things you have to watch out for. You have to be aware of the pro rata rule. So if the pro rata rule says that this is fine if you don't have any money in an IRA, You can move that whole. Let's go back to this chart. Let's use the allowance that we can put into IRA or Roth IRA this year. So assume you're over 50. Let's use the over 50 catch up, because this year in 2024, remember, it goes up every year typically. Just like I explained to you, the phase out levels, your contribution levels also increase. So if you're under 50, you can put in $7,000. If you're over 50, you can put in another $1,000 for a total of $8,000. Let's assume that you listening are over 50. Now you've put in your $8,000 into your Roth IRA. Write it in here, $8,000 into your Roth IRA, and you've sent that, your traditional IRA. You've made a non-deductible contribution of $8,000 into your traditional IRA, and you've then converted it immediately over to your Roth IRA. So now the $8,000 sits over here, and your Roth IRA, same effect, just like you deposited it directly, you just took that extra step. But the pro rata rule says, well, not so fast. If you have money in this Roth IRA, your traditional IRA, let's say, for example, you have $100,000 in this traditional IRA, then only a portion of the amount that you transfer over to the Roth is going to be a tax-free transfer. The other amount is going to be considered a taxable conversion. Because remember, if the $8,000, and I know it gets a little cloudy here, but let's go here. Let's just bring it down here. So we have traditional and we have Roth. You're depositing $8,000 into here. Don't wait. You immediately move it over to here so you don't earn anything in that traditional IRA. But you've already paid tax on this money, this $8,000. This is after tax. That's important. That's an after-tax amount of money. And the current tax code says, well, heck, that's okay. This is after-tax money. You've already paid tax in it. Now just move it over here, put it into the Roth. But if you've got, as I said, if you have $100,000, and that only works if you have zero balance in here. If that's not the case, if you don't have zero balance in there, and let's say you have a $100,000 balance in here, then you've got to use a pro rata rule. You follow the pro rata rule, which pro rata means loosely percentage. So we have to take the $8,000 and we have to divide it by the $100,000. So that gives us 8%. Now we have to take 8% of the $8,000, and that gives us $640. So only then $640 transfers over tax-free, remember, because it's after tax. The tax code says now the remaining amount of that $8,000 is now a taxable conversion. So I've gotten into the weeds a little bit about that with the pro rata rule, but you got to pay attention to that pro rata rule. To make sure that you understand the what you're getting yourself into. But that is the backdoor Roth contribution. Again, conversion doesn't make sense, backdoor Roth conversion, because you can do a conversion anytime. You're backdooring that contribution through the tax deferred IRA directly to the Roth. So let's just do that one more time. You're backdooring it here. Okay, makes sense? Hope that makes sense. Now, let's talk about the proposed changes. And we're going to refer to. So we explained what is a backdoor Roth contribution. All right, let's take it back and let's keep it red. Let's keep it red because it's not good news. So now we're going to talk about the general explanation of the administration's fiscal year 2025 revenue proposals. And we're going to go to page 86 here, modify rules relating to retirement plans. And then we're going to focus again on page 92. So here, the first thing we want to focus on is their definition of a higher income taxpayer. And you'll see here, this is the website you can go to pull this down. It was issued March 11th, Department of the Treasury. And the title is General Explanations of the Administration's Fiscal Year 2025 Revenue Proposal. Now, of course, this comes out from President Biden's office, but this is not a political statement. I'm just sharing with you what is coming out of Washington and the White House in particular. So the definition of a high-income taxpayer, starting here, a taxpayer is considered a high-income taxpayer if for the taxable year the taxpayers modified adjusted gross income is over $450,000 if the taxpayer is married and filing jointly or is filing as a surviving spouse, or over $425,000 if the taxpayer is head of household, or over $400,000 in other cases like single filer. So that's the definition. Now, last week we talked about the fact we're dropping down here to limit rollovers and conversions to designated Roth retirement accounts or to Roth IRAs. And we spent a lot of time last week in this section here because it would limit the ability for a high income taxpayer to do a Roth conversion at all. So if you cross over those four, and if you haven't seen that yet, you can go back to last week's webinar, and I'll link that too in this one. But this proposal would limit your ability to do a Roth conversion if you're a high-income taxpayer. So I explained to you what those definitions are. $450,000 in modified adjusted gross income if you're married filing jointly. $425,000 if you're head of household, and $400,000, the way I'm reading it, if you're a single filer or married filing separately, probably. And we don't know if there's any exclusions for Roth conversions in there, but I'm guessing probably not. But let's focus on this section here. So similarly, this proposal would prohibit a rollover of a distribution from a tax-favored retirement arrangement into a designated Roth account if any part of the distribution includes a distribution of after-tax contributions, unless the distribution was from a designated Roth account. So that's telling us that's the death of the backdoor Roth contribution, because the contribution you make to an IRA, a traditional IRA, is after tax. It is a non-deductible IRA contribution. Therefore, it is after tax. They're saying that if it would prohibit the ability to convert. Now you've made that contribution into the IRA. You do the conversion into the Roth. That's your backdoor. Remember, IRA, traditional IRA, Roth. You're going like that. They're saying if any part of that, even if in the pro rata rule only $640 of it is an after-tax contribution, they're saying it can't be done. So they're nixing. This is the death knell for the backdoor Roth contribution. So that one sentence erases everything. Now, this is not law yet. I don't know if this is going to pass now. I don't know why they would do this, frankly. It doesn't really make sense, except they don't want people who they see as, this is not a political statement again. I'm just giving you the flavor of what's coming out of the administration. They're saying they don't want high-income earners, in this definition, high-income earners I shared with you, is $400 some $1,000. But I don't see the connection here where that $400,000, $425,000, $450,000 applies. This seems to revert back to the income thresholds for the allowable contributions to a Roth IRA, which I shared with you, are much lower. Those thresholds. Remember, I'm going to come back over here with me. We're going to go back up here. Today, where are we? Today, if you're married and you make, your modified adjusted gross income is $240,000, and phase out begins at $230,000. But let's leave it at $240,000. Geez, that's getting messy. I don't see the distinction where it says only high income earners per the new rule. Now, again, maybe I missed that, and I've been reading through this document. If somebody sees it, you let me know, please, in the comments. But I'm not seeing that that specific item saying only for high income earners. So that is the death knell for backdoor Roth contributions. Now, again, I don't know if this is going to actually take place. I don't know when it's going to take place. I don't know if these provisions will all be accepted and go through. I don't know if a portion of them will go through, but we've already seen in this section here, no more Roth conversions for folks over $450,000, $425,000, or $400,000, depending on your tax filing status. So no Roth conversions. And then the death of the backdoor Roth contribution. There are many other things in this report that I'm going to be going over in the upcoming weeks. But what I want to really bring to your attention is this is really the future of our tax rates. We're starting to see this now, where things are getting these gifts that we have of Roth conversions. Regardless of your income, you can convert as much or as little as you like under the current tax code. That clearly is on the chopping block, at least. And coming, when it comes out of the White House, that's serious stuff. This isn't just a proposal from one or two Congress people. This is the current administration, who might be the administration again for the next 4 years. Who knows? But this is important stuff to pay attention to. But we're on the door. We're standing at the doorway of some significant tax code changes, including much higher tax rates. As part of this proposal, as I'm going to talk about next week, is much higher capital gains, or maybe not next week, but in the future, and we'll talk about much higher capital gains rates. Now, you're going to see the income levels, and they're very high income levels, but this tax train is coming, because it can't just be on those folks at $1 million, $10 million, whatever the thresholds are. And frankly, mathematically, it can't just be at the folks at $400,000, $425,000, $450,000. That's why I wanted to point out to you that it's likely that the end of the backdoor Roth contribution is dead for everybody, because I'm sure they're going to follow the current phase-out levels. That'll continue to adjust for income. But again, if I miss something in the report, somebody tell me. But that's the way I'm reading it. I hope that was helpful today. There is good news, folks. We still have time. We still have at least this year, this tax year, this proposal. Many of these items are set to go into effect next year. But I don't know if this is a proposal. Again, this is not legislation. It's not pending legislation. These are proposed revenue changes, and revenue equals tax. But you've got to pay attention to these things. When I started teaching and applying tax efficient strategies all the way back to 2012, the changes seemed so far away. And in fact, in 2017, our ability to do Roth conversions got much easier with the Tax Cuts and Jobs Act. But that may be tightening much, much sooner than expected. And it's coming. So let's get to work. Let's open our minds. Let's pay attention. We want to let as many people know as we can. So share this video. Tell your friends and loved ones to subscribe. Learn these things. Stay educated. Stay updated. And move forward. I hope that was helpful. Have a great week. We will see you next week. Tuesday again. We've got a couple more Tuesdays before the change to Wednesday. And I'm really looking forward to some of the guests that we have scheduled to come up, some of the events. I didn't mention this, we just finished a in-person class, and that was a lot of fun. And I see Leighton has a question. So Leighton writes, correct me if I'm wrong, but the proposed rule prevents the Fed from harvesting immediate tax revenue. Yes? That's, it really doesn't. So Leighton, if you're talking about the proposed rule that limits Roth conversions for what they call higher income individuals, yes, it would stop the federal government from harvesting immediate tax revenue, because you're stopping people who are at the higher income levels from doing conversions, and there are folks who do conversions. The ability to do the backdoor Roth contribution, again, that's already taxed money, whether it's coming from your earnings or whether it's coming from your taxable bucket where you're going to pay capital gains tax. There's what you're doing is you're moving that to never taxed. So I don't agree with it. I like being able to do backdoor Roth contributions for myself and for clients. But I see what's happening there. They're saying, okay, well, we're taking, if you do 8,000 times 2, $16,000 a year for a married couple over 50, we're putting that money away. You're paying tax on it now, putting that money away, and it's never taxed again. So again, if it's coming from your earnings, then it's already taxed. They already have the money. The if it's coming from capital gains, you might be right. You might be saying that, hey, maybe I would keep that money. I wouldn't realize those capital gains, and therefore you're not getting my tax money, Congress, IRS, the federal government. But I think that I think they're thinking differently, and they're coming for our capital gains tax, by the way, and they're coming from the money that's not that's deferring that tax by holding those sales. So anyway, that's the best I can do with that. Let's hope that again, not a political question at all, or a statement at all, but let's hope that we see some moderation in the actual tax code. Things have to change, folks. As a planner, I hope it's pushed off as long as possible. As an American, things have to change to get our fiscal house in order. Our tax rates have to increase. Capital gains tax rates have to increase. Marginal income tax rates have to increase. I don't agree with limiting the ability to do Roth conversions because to Leighton's point, that is absolutely a cash cow for the federal government in the immediate term. And we know that they are not long-term planners like we are. If they were long-term planners, they'd want the money to stay in IRAs, but they seem to want the money to stay in Roth, or to go into Roth IRAs. Every proposal that I've seen before this was pushing money into Roth IRAs because they're money hungry now, right? They want that cash now. This is the only one that I've seen that puts a limit on the income level for Roth conversions. But it's very specific. It seems to be targeted at folks making over a certain amount of money, $450, $425, $400, and that is the message, by the way, out there. So I hope that was helpful. And again, there's good work to be done between now and when changes take place. And stay informed, stay educated, stay on top of things. And I look forward to seeing you all soon. Take care. Bye-bye.